Good afternoon, everyone. Thanks for joining us. My name is Dave Judas, and I head up the Intermediary Sales and National Accounts Group at Barron Capital. Today, we're discussing the first quarter for the Barron Small Cap Fund and Opportunistic Small Cap Growth Strategy with our Co-CIO and Portfolio Manager since inception in 1997, Cliff Greenberg. Hey, Cliff.
Hey, Dave.
And his assistant PM, Dave Goldsmith, who's worked with Cliff since joining the firm in 2006. Hey, David.
Hi, everyone.
All right, thanks for joining us, guys. Before we start, I want to congratulate both Cliff and David on their impressive long-term results. We can see on the first slide, the fund handily outperforms over all long-term time periods while delivering over 404 basis points of annualized excess returns over the Russell 2000 Growth Index since inception in 1997. All that with a 10-year beta of only 0.92 and a 94.86 upside-downside capture ratio. As you can see on the next slide, the Barron Small Cap Fund's outperformed its benchmark 65% of the time on a rolling 5-year basis since inception, and that percentage rises to 100% over those rolling periods where the market declined. The fund also outperformed its Morningstar peer group 92% of the time since inception on a rolling 5-year basis. If you have any questions today, you can type them in the Zoom box or send them to questions@barronfunds.com. We'll do our best to answer them on the call or with a follow-up from a Barron salesperson. So with that, I'd like to kick it off with Cliff. Cliff, perhaps you can share your perspective with us on the first quarter?
Sure, Dave. And thank you for that nice introduction, and welcome everybody to this Zoom video, and appreciate you joining us to hear what's happening in the fund and our perspective on the markets. Well, the first quarter was pretty interesting, lots and lots of cross currents. Early in the quarter, the market was really strong. Economic reports showed that inflation was softening and that the economy was slowing down, which led market participants to believe that we were close to the end of the Fed rate hiking cycle, which was good for stocks. But as the quarter wore on, economic reports kind of strengthened. Inflation proved to be kind of sticky. The Fed talked tough, and there was fear that continued rate hikes were in front of us, all leading towards a retraction in the market. And then later in the quarter, SVB failed, which added a new concern that maybe credit would be less available to those businesses and consumers that needed it, which raised ire about the future pace of economic growth. So lots happened on a headline basis during the quarter. All in, on the other hand, stocks did actually pretty well. And our fund performed well, and both on an absolute and relative basis. We believe that stocks did well because we are close to the end of a rate hiking cycle. It's our view that stocks are cheap and oversold, and we're going to discuss this in a little more detail later in this presentation. Business fundamentals remain pretty firm, and probably leading to some of the outperformance of our fund. The stocks of quality companies did better, and as many of you know, that is the concentration of the holdings in Barron Small Cap. Dave, why don't you get a little more in depth and tell us more about the details of the performance of our fund this last quarter?
Sure, happy to do that. Hello, everyone. So I'm going to talk about the Barron Small Cap Fund performance versus the Russell 2000 Growth Index. Our fund was up 9.4% in the quarter versus the index of 6.1%, so relative outperformance of 3.4%. The outperformance was split roughly between allocation and stock selection and overexposure to earnings quality and growth factors. The outperformance was broad-based. 10 names were up 30%, 16 names were up 20%, with only one name, a detractor, down 20%. What we saw in the quarter, what Cliff referenced, is some of our worst performers last year were our best performers in this first quarter. Floor and decor was down 46% last year, yet up 41% in Q1. Installed building products down 37% last year, up 35% in the first quarter. And another big holding, Site One, down 51% last year, up 17% in the quarter.
On this point, Dave, as we tried to explain last year, many of our stocks that were considered to be interest rate sensitive really got beat up last year on concerns that their businesses would really fall apart into a higher rate cycle. It worked out that actually many of our companies' earnings were good last year, or held in well, and the outlooks this year still are pretty positive. So those stocks which really performed poorly last year have been making a great comeback so far this year, as we kind of suspected they might.
Yeah, the earnings reports from the fourth quarter, given in February of this year, were pretty good.
Yeah.
And the outlooks were fine. And that's why you saw, I think, multiples come up a little bit for not only our names, but the small cap space too. One mention on the detractors was Gartner was a biggest detractor, but only down 3% in the quarter, relative underperformance versus a strong year last year. One note I did want to make on the quarter in terms of buys and sells, we weren't super active in the quarter, but we did add to a name, Clarivate. That's a software company with mission-critical software that's embedded in their customers' workflow, serving life sciences, academia research, and intellectual property. That's a business that's very fundamentally sound, high recurring revenue software at 80+%, high customer retention, 90+%. And this is a really good business serving recession-resistant markets. The management was replaced. Old management made some big acquisitions that we liked, but I think took their eye off the ball on their core business. Organic growth suffered, and they overpromised and then delivered to the street, losing a little bit of investor faith. What we are excited about is new management now coming in with some years of those acquisitions under their belt, integrating them more thoroughly, and we think they will reignite growth as they focus on the base product. New management can maintain those 40% EBITDA margins and grow free cash flow as those integration costs start rolling off. I think that will be an eye-opener to the street as leverage comes down. This stock is silly cheap, 12 times free cash flow versus the peers that have similar financial metrics trading at over 25 times. So we think this is a company will be more noticed as the debt comes down and the free cash is evident.
Yeah, and one of our practices is to, when stocks that we own get to levels that we think offer a great upside, we'll add to those positions, especially when we think they're on the cusp of having better results and changing market perceptions. And this, to us, is a very high-quality business at a very cheap price, and therefore one worthy of a much larger investment inside the fund.
I'll also just point out that we added to Neogen and Chart names that newer positions that we've called out in past calls as we've gained conviction in those ideas. And I'd encourage everyone to reference our quarterly letter, which we took a lot of time and put a lot of company-specific details in the buys and sells there.
That's a great start. Thanks, guys. Appreciate that. And I'd encourage everyone to read your letter. It's always a good one. Let's turn back now to Cliff. Maybe some thoughts on outlook. We're 4 months into the year, and I know you guys talk to companies all the time, and you obviously are in the markets every day. What do you think at this point from an outlook perspective? What are you seeing?
Well, market strategists and prognosticators focus on the big picture and generalize about what's happening in companies and in the economy. It's our view that we prefer to look more carefully and closely on a micro level with our companies and our portfolio holdings. And we come to different conclusions, or our take is different on a handful of important points to what people are most concerned about. So prevailing view is that stocks are expensive, and most market commentators are saying that stock multiples are too high. We view our stocks as being very cheap. I reference a slide now where I'm showing the top 10 holdings of our portfolio. The multiples that you see are based on our internal estimates on what we project the companies will earn this year and next. And my comment would be that 3 of these 10 seem to trade at what we think are reasonable long-term multiples, but off which we'll make good returns because we expect nice growth from those businesses over time. But 7 of them trade at multiples that are well under what we think are the appropriate multiple for those companies. And that leads to more upside in our portfolio because ideally we'll benefit from both earnings growth and also from multiple expansion. The second concern in the market, general concern, is that we're going to fall into a recession and companies' earnings are going to decline this year. Well, we expect growth. Of the 60 companies that we own in our portfolio, we presently expect 52 to grow their earnings or EBITDA, free cash flow, the appropriate metric this year. That again is based on our own internal work and our conversations with those businesses. The growth won't be up to historic levels, meaning standardly our companies kind of grow value 20-ish% a year, and this year will be harder to grow at those levels, but still growth. The ones that are declining are primarily coming off very strong 21 years, and therefore we foresee there's tough comparisons. We foresee a nice growth in the future. Now, I think our portfolio is probably different than the market in general in that we invest in what we think are special niche secular growth companies. So in tougher economic times, they'll do better than most other businesses, but still we expect growth in our company's earnings this year and go forward. The third point is that earnings are rolling over and major cuts are expected later this year. Well, so far, or we presently the earnings of the companies we own have been very resilient. Most haven't yet reported their numbers yet for this first quarter, so this comment is premature and subject to a change in mind, but we're in pretty constant communication with the companies that we invest in and therefore have a pretty good feel on their business. And generally, business is slowing, but it isn't declining dramatically. Actually, after the fourth quarter, last earnings cycle, we raised estimates of the companies that we own twice as much as we cut estimates. And therefore, we kind of feel good about the near-term returns or growth of our businesses. So these are very uncertain. To summarize, some of the big bugaboos I don't really agree with and don't believe that's the cause of a major market sell-off in front of us. But I do profess to being uncertain at this time because it is a confusing time. The negative or the flip side would be that the economy gets weaker much more than we're presently seeing, which is possible. And if that is to be the case, then the macro might overwhelm the micro of our stocks, which is kind of the environment we were in last year, and and stocks would have would be in a bit of a tougher environment. So I profess not to be rooting for the former, but not to be to be honest in saying that we really have a sense on how things are now, but it's not the easiest to put a finger on how things will be 6 months from now.
Makes sense. Thanks for that, Cliff. Appreciate it. And I like illustrated how we think differently than necessarily the consensus there. So maybe we could jump over to David now for some thoughts on small cap investing, small caps in general, and it's now a favorable time.
Yeah, happy to do so. The pictures tell 1,000 words. In this first slide, you're seeing small caps are cheap compared to historical levels. And then as we turn to the next slide, you see that small caps are cheap relative to large caps. Small caps usually trade at a premium because of the faster growth, but you can see this is out of historical levels when they're actually trading below large cap stocks now. In fact, the ratio of small caps to large caps is back to March 2020 levels, and that's the lowest levels we've seen since February 2001. So any way you slice this chart, it looks like small caps are cheap relatively. And we think some of that relative dispersion in valuations is leading to more M&A. We're starting to see that in our portfolio and others are around the small cap space. one thing that we think is backwards is small caps are overexposed to passive investing. 60% are small cap is passive, 50% large cap, 40% mid cap, and we think that should be the opposite. Small caps are, again, valuation dispersion. 20 to 25% of the small cap industry is losing money, and only 2 of our names are really losing money now, and with a very short path to profitability. So we think this is the way to play small cap, is through active management. In fact, small cap is more successful in active investing is more successful in small cap 6 out of the last 8 years and each of the last 2 years. And we think it's a stock picker's market, as downturns tend to be the best regimes for active funds like ourselves. And so, and just a little pitch on us is we beat the index 5 out of the last 6 years.
Well done, Dave.
That's great. Yeah, not easy to do. So well done by you guys. That's impressive. So thank you for that. And certainly compelling time to invest in small caps. Maybe one more question. I'll shoot it back over to Cliff. We've heard from a lot of our investors, their perceptions of the markets being what they are right now. Why not just park, some assets in cash and earn, 4% or so? What might you say to those folks?
Well, I would say that I agree that these are uncertain times, and the markets were terrible last year and have been rocky this year. And also that the returns on cash are much more attractive now than they have been in the past. But I do want to point out that the returns in our fund over time have been substantially greater than those than the 4% or so that you can get in cash right now. And from the levels our stocks are trading at now, we would suspect that our returns go forward would well exceed those that you can get in cash. It's really hard to time when one should own stocks. So our preference is just to kind of own special companies for the long term. And let me try to make this point by giving you an example of, a long-term holding that, and why we think, this stock has performed very well in the past and will perform very well in the future. Red Rocks Resorts, one of the large holdings in the fund, is the leader in the locals Las Vegas casino market, which is a subsector of gaming, primarily providing services to people who live there as opposed to tourists. Las Vegas is a growing, booming market. That's right, exactly.
Moving from California.
Exactly, and it's the fastest growing market in the country, and the people who are moving into Las Vegas are wealthy and love going to a local casino to kind of, spend their money and spend their time. The business has huge barriers to entry, meaning Las Vegas limits the amount of casinos that can be built. And Red Rocks is very deftly assembled a portfolio of real estate in which they own all the most and the best development sites for any future growth that will take place in Las Vegas. Red Rocks is the best-in-class operator. They have the nicest facilities. They have the most loyal customers. And it's also an incredibly well-run and high-quality business. Management has run this business for over 30 years and has a huge stake in the company, similar to us. We and they are the 2 largest shareholders in Red Rocks. The company has a pristine balance sheet. The company earns 45% operating margin, so it's a high profit business, and one that has returned $650 million back to us, the shareholders, in dividends and repurchases just over the last handful of years. So, but the main reason that we really like this business, and most of the businesses we invest in, not only is it a terrific company as is now, and it's proven to be the case, but that Red Rocks has substantial growth on the horizon. Presently, the company makes about $750 million from 6 large facilities, but they own 7 parcels in which they hope to build world-class resorts over the next decade to more than double their footprint. The first one is called Durango, which opens this fall in the back half of this year. It's a $750 million investment that the company's making in a state-of-the-art new facility in a great location where a lot of the demographics have improved and lots of that inflow of population kind of lives. We believe that the company will earn some, very, very strong returns on this development and most of their future developments. In fact, since they've been building new casinos for the last 30 years, on these greenfield builds, they've earned over 20% IRRs, which is
amazing in context.
Yeah, I mean,
hotel development.
Yeah, most hotels and real estate developments are sub 10% return. So a 20+% return is really outstanding. So just to frame the upside in this Red Rock stock, the company is presently valued at about $7.5 billion on an enterprise basis. They're doing $750 million of EBITDA, as I just mentioned, so about 10 times EBITDA, which is cheap in its own right. We think Durango they believe they'll earn over a 20% return. If we give it a little less return and say it does $125 million of EBITDA over time, well, then the overall EBITDA of the company grows from 750 to 875. Putting an 11 multiple on that, which I believe is lower than the stock should trade, but higher than it presently does, so a conservative long-term multiple in the stock. Well, that drives a $70 price target against a $45 stock trade right now. And then, as I mentioned, the company has 6 more projects in line that, probably every 2 years they're going to build another one or another 2, and which in time we kind of to snapshot it, each one of these new casino builds will probably add at least $10 a share to the stock price. And therefore, a stock which is presently trading at $45, we think after Durango is built and successful, will be worth 70 and then grow to over 120 over time. So up multiple fold from where it's presently trading. So that's a, kind of a quick story to explain what our long-term investing is all about. Should one be in cash earning 4%, or should one long-term be in Red Rocks where the stock we think can go from 40 to 120? We prefer the latter. And, we have a portfolio filled with companies like that have what we believe are, multiple fold upside ahead of them as businesses kind of grow off their successful base that they've already created. So, Dave, that's a long answer to a short question, but I hope it explains how our minds work and the essence of how we go about being long-term investors.
I think it's great. Thanks for that answer, Cliff. It's great, and I would agree. I'd rather be in a Red Rock. Sounds like a great opportunity. So appreciate that. And that's going to conclude our discussion for today. Encourage you to visit baronfunds.com for replay information on this, as well as other PM webinars for our other funds. I want to thank everyone for joining us, and most importantly, thank you for investing with us. Have a good day.
Everybody, good luck to the Knicks. Good luck to the Lakers. Go team.